So I'm Howard Halderman and really appreciate you coming today. We've got some folks that are joining via Zoom. And so that's what this device is back here. And hopefully that'll be able to track me and hear what I'm saying. We're going to talk about, my job here is to talk about land values and rents and what farmland has been doing. This is my fourth seminar of the week. I've been to Greensburg, South Bend, Reynolds, which is north of Lafayette, and here today in Fort Wayne. So I can tell you the state is generally in the same condition, no snow and generally wet. But it's March 3rd and we're not trying to do anything in fields generally anyway. And so it's not a bad time. And we were awfully dry up until the last few weeks. So I'm going to kick it off a little bit about the Halderman companies. We are in our fourth generation. My grandfather there in the middle started the business 92, 93 years ago. My son, who's back here, Joe Halderman, is our fourth generation in the business. And we basically represent landowners. So landowners of all types, individuals that own property themselves, corporations, bank trust departments, and municipalities. So when we talk about representing them, we have agents or representatives that are all over the state of Indiana. Specifically, when you think about Northeast Indiana, we have Neil Woolheater. Neil's out of, I don't know, East Corner, basically, but in that LaGrange and Noble County area. Rick Johnlow's over here is out of Bluffton. So if you got questions about land north of Fort Wayne, Neil's your guy, Rick's the guy south of town. Pat Karst over here on my far left is out of Huntington. Pat runs the real estate side of our business. And then back here in the middle, Nolan Sampson is our business development director. Nolan's job is set up events like this. So he's the one running all the technology back there and making it look like you're in a computer lab. And then, of course, Joe Halderman's out of our Wabash office, and he's working the north central part of the state as well. So we manage farms. We do farm sales, 240 million last year. We did manage 700 farms, and then we also did about 1,200 appraisals. So if you talk to Rick or you talk to Neil, they probably know something about farmland values and something about rents and how to rent a farm and how to manage that whole exercise.
I didn't even see it over there until that.
And then the last point on this slide, I think, is pretty representative of the group we have here. We have an average tenure of our staff of greater than 20 years. Think about Rick, Howard, maybe Pat, and we've been around a little longer than 20 years. Whereas Neil, Joe, and Nolan are a little on the other side of that. But that's how we get the average. And so when you get a Halderman person, you're probably going to get somebody who knows that area really well. And then this is just an example of where all the farms are that we manage. We're going to focus our efforts today on Northeast Indiana specifically. So farmland, I think it's no mystery, values have been strengthening. They've gone up quite dramatically since 2 years ago. We talk a lot about why farms sell. And you may ask, well, Howard, we saw a lot of farms on the market in the fourth quarter, and that's right, you did. The market is a little thinner now. But I would suggest to you that one of the reasons farms sell, primary reason, is a life change event. So one generation has passed on, the next generation inherits the farm, there's 5 kids, and they say, you know what, we're going to divide the money, that's easier to divide than acres. So the farm is sold. That's usually the reason a farm gets sold. But sometimes there's other reasons, like a tax law change or a potential tax law change. That would be called an outside driver of farmland sales. Maybe it's a farm bill change. Maybe super high interest rates a la 1980s causes people to have to sell. Those are some outside drivers that we really have not experienced any of since 2012. And back in 12, you had Mr. Obama going to definitely be reelected. You had a Democratic Congress, and there was fear that the capital gains taxes would go up. They never did, but that fear spurred a lot of people that said, hey, I want to sell in the fall and get that closed before year end. We saw a little bit of that dynamic last fall, but not because of tax law change. We're at the all-time high of farmland values. Inflation adjusted, all-time high. So if you're that Warren Buffett guy that wants to buy low, sell high, you're at that, what I would call sell high moment. There were some folks last fall that came to us and said, hey, we want to capture this all-time high, and we want to definitely sell this fall. So that was a little bit of an outside driver, but it was more internal to farmland itself. So volume picked up last fall. I would say that we're really in a very normal state. If you say, well, it seems like a lot more than the last 5 or 6 years, yes, but those last 5 or 6 years were below normal in terms of volume of transactions. Cropland values were extremely stable. They peaked. The previous all-time high was 2013. We just went over that in the last couple of months because of inflation. But we then fell 15 to 20% from 2013 to 2015. And then we kind of were in a flat sideways channel. And I'll show you that on a graph here in a second through 2021. And then due to much higher commodity prices, demand globally, combined with a lot of domestic demand drove those commodity prices higher. Trade deals with China really helped. And we saw farm incomes go up in 2021 and land values as well, plus inflation here. And farmland is very positively correlated to inflation. So we are at the all-time high. Even if you adjust for inflation, you are on your balance sheet. If you're an owner of farmland, it's a good thing. If you're a seller of farmland, it's a good thing. If you're a buyer or trying to get into the industry, it's a challenge because it's usually capital intensive and really hard to get into these kind of prices. Now, Northeast Indiana, especially when you think about Neal's area up north, there's a lot of land that isn't cropland. It's recreational land, it's woods, it's pasture, it's stuff that you ride four-wheelers on or hunt on. Believe it or not, those values appreciated significantly as well. So they were not immune to this inflation push, but it was also due to demographic changes where you saw some folks that might live in the city of Fort Wayne that say, hey, I'm fully employed, I'm making good money, interest rates are low, I want to maybe have my own piece of property out in the country to enjoy. And so, and I get away from people, not in a densely populated area, which COVID kind of spurred some folks to think about that. And work from home. So we're going to start really big picture. This is USDA cropland values. So this is all cropland across the entire country, $4,420 an acre in 2021. You can see that very flat sideways market was consistent, not just in Indiana, but it was consistent across the entire US. But you see, based here, we are at the all-time high. Well, now we'll get a little more dialed in. This is the Federal Reserve Bank of Chicago. It includes the 5 states over there on the far right. Indiana would be the dark blue line. We did win this past year, January to January, with a 22% increase, 23% increase in land values. These are the opinions of FDIC insured ag bankers. So I want to be real clear who's contributing to this. It's an opinion survey, it's not really sales results. And you can see that the whole district was up 12% year over year. That's down from the previous year. So it's still going up, but not as fast. And you can see the fourth quarter, 10/22 through January of 23, pretty flat. So we're kind of seeing the impact of interest rates starting to really moderate farm prices. And I think it's also indicative that there are some concerns about where commodity prices go in the future. Brazil's got a really big crop right now. And what's global demand going to be? And I think if you listen to a lot of experts, there's a lot of unknowns as we go into this crop year. Now, the February crop insurance price was pretty favorable, right, guys? And so it provides an opportunity to put some revenue coverage and plug in there for you. Yeah. But I'm going to quit because I don't know much about it. But the revenue coverage is something that you could be a real positive for farmers as we look at this year. Now, we get down to even more specifics just about Indiana. And this is the Purdue survey. Now, this goes back to June. So it's kind of dated at this point. But really what I want you to look at is just the trend line, not so much the numbers. There on the far right, the best land in the state of Indiana is an average opinion of $12,750 an acre. I would suggest to you that most in this room, if you have that quality of land, would not sell that farm for $12,750. Maybe 15, but you're not selling for $12,750 today. I wouldn't recommend that you do. So these are opinions of farm managers, ag appraisers, and rural brokers, farm real estate brokers that all contribute to this survey. But it kind of gives you an idea of the trend. And you can see on a nominal basis, so if we take inflation out of it, we are well above the all-time high in 2013. We'll look at it adjusted for inflation in a second. So now we're going to get really tight into what Halderman actually sold. And we analyze our sales. Pat does this for us. He takes farms that are 80% cropland or more, right, Pat? And basically takes the sale price per acre and divides it by the productivity index of the soils that exist on that farm. In all soils in Indiana, Ohio, Michigan, they're all rated for their ability to produce corn. And the range is kind of 100 to 185, 188. That's not really indicative of what they'll produce, because these were set a number of years ago. But it gives us a way to compare farm A and farm B that might have different productivity indexes. This does not accommodate for drainage. It doesn't accommodate for fertility. It's just a comparative tool. So we take that sale price and we divide it by that productivity index, the WAPI, weighted average productivity index, and we come up with so many dollars per corn bushel of value. And you can see in early 21, the first half of 21, we traded somewhere right in here in the $50 per bushel range, 55 actually. And then you see that jump up to 80 for the remainder of the year. The other thing to note on these is volume. The narrower the band between the quarters, the less volume we have. These are all individual sales. You'll notice a lot of volatility in that. That's because every farm's unique. You know, I get people that say to me, well, Howard, we're just going to sell our farm based on the Purdue survey numbers. Okay, you can, but every farm is different. And I'll show you that in a second, a big vast difference in two that were very comparable in terms of soils. But location does factor into real estate values, and you need to accommodate that. So we went from the 55 range up to the 80 range overnight in the second half of 2021. Trade deal with China, demand, higher commodity prices, and pretty good yields at that point. So put it down in actual numbers. You can look at the annual average for 21 was $71. The first half of the year was 55. The second half of the year was 80. Now, 22 average is $85. So again, we went from 21 average of 71, we jump up to 85. And that was probably a 50–60% increase total in values from where we were prior to the first part of 2021. Another way to look at it are sales over $10,000 an acre. You probably have all heard of sales 10, 12, 14, 15 in your area. That was not all that common. If you go back to 2019 and 2020, you know, less than 10% of our sales were over 10. Then we jumped to 17%. Now it's almost expected. So again, just documenting that increase. Here's the 22 chart, much more volatile, a lot more spread in the overall range. And I did a Top Farmer workshop back in early January. And one of the questions we got was, you know, where were we in the fourth quarter? And where do you think values, or what will farmland values do in 23? And I looked at this and I said, notice in Q3 how narrow the range is. And then as we go on in the year, that range expands, more volatility. What that means is you're going to have some sales that set records, but you're also going to have some sales where you'll scratch your head and say, that seems cheap. We had one the other day in Carroll County over by Delphi. And for its productivity, it has an APH, annual production history, crop insurance APH of 219. It's a good farm. Sold for $9,900, $10,500 on cropland basis. That's cheap for that quality. So you're going to have more of that show up, and that's really due to the interest rates and some of the concerns that exist out here. Here's 23. Pat just updated this yesterday. You can see we're still trading well in that 90, 85, 90 range. So the market is holding steady. Haven't had a lot of volume in the first quarter. I think people that were going to sell in the off season from 22 to 23 kind of did all that in the fourth quarter and not so much in the first quarter. Now this chart I really like because it demonstrates the significant increase in land values. This is that 2016 through 21 that I said was a very sideways market. You remember the USDA chart, very sideways. And then you see the big increase there at the far end over the last 2 years. So here's a whole host of sales. I'm going to do these pretty quickly. You can notice on this, there's nothing less than 10,000 an acre. This is back in July and August of this year. Really nice sale up in Whitley County at 14,000. And that was a very average farm. The Whoppy on that actually was below the average for the state. And at 14,000, you see it's $104 per bushel of productivity index. We'll go through these. I want to point out, we've got one set of, there's this one, I think Pat would suggest to you, because he knows this farm fairly well, managed it for a number of years. This one was probably a little on the light side. We sold another one a couple miles away for 14 a month later. So my point being about the volatility. So we go here in November. Now notice these two sales. This one's in Cass County, Logansport, and this one's Delaware County. That would be Muncie. These farms are pretty comparable in terms of their soils. That's where it ends. Notice the price difference. It's almost more than 100% difference in price. Those were the same day. One was an online only auction, one was a live with an online component. You'd say, well, Howard, the live one sold a lot better. It did. That's not the reason. It wasn't auction type, because I've had Pat analyze our sales and we compare online only to live events. And I can tell you online actually generates a little better price. So it isn't the fact of how it was auctioned, it's about location. See, the productivity index on the Cass County is 148, the Delaware County is 145. And it brings on more than double. Well, that Cass County's up by 12 Mile. Anybody know where 12 Mile is? Nolan, of course you do. 12 Mile, maybe not historically the best ag address in the state. Whereas this Delaware County, I think, is more average, and this farm was rated, our representative on this said this is the best farm in Delaware County. That's what reputationally it's known as. So as you think about your own farm property, do you maybe it can't be known as the best farm in LaGrange County, the best in Noble or Allen or wherever, but what can you do to make it better? And when we manage a farm property, that's the vision that we have. Can you make the fields more efficient? Can you improve productivity through fertility or drainage? Those are the kind of things that the owners here in Delaware County have done over the years. I don't know about the Cass County farm. I think that was really had more to do with its location, and it was significantly discounted as a result. So just kind of an interesting study as to why when we do a farm appraisal, it's hard to do, because just on face value, you'd say that doesn't make any sense. Going on into December, a little more variability. You have floodplain, thinking about today. If you have floodplain, it could be pretty cheap still. Yeah. That Pike County stuff floods, I think, every year. Here we are coming into the new year, and still some pretty big numbers. And I'm going to take you right through last week. Here's even 11.7, but it was only $73. So that tells you that even though it was a good sale from price standpoint, it was maybe a little less than average on the Whoppy score. And then you can see that one in Carroll County last Thursday. So that's where the market has been. Now we're going to talk about where the market's going to go. If you want to follow our listings, you can on our app. You can download that for free. You can follow what auctions are upcoming, but you can see what stuff is sold for as well. So who are the buyers? I get this question and had it last night. And that was not a presentation on farmland values, but they said, now, how many foreign buyers are there? Who is aware of the Indiana foreign ownership law today? Yes, Nolan, you should be. You've been at all these seminars. Thank you for being a willing participant. So last April, the state legislature passed a foreign ownership law. If you are foreign to the United States of America, you cannot buy Indiana farmlands there properly, unless you're affiliated with livestock production. Now, the group last night in South Bend, they laughed at that because I think a lot of them knows Smithfield Foods, one of the largest producers of pork in the world, is owned by the Chinese. This law, talking to Representative Snow and State Senator Zay, starting to get into this area here. I met with them in May and I asked them about this legislation. I said, y'all, who owns Smithfield? No. I said, yeah, the Chinese do. Oh, this was kind of an anti-Chinese, anti-Russia law. I said, I get it. you kind of maybe needed to ask somebody that knew something. But that's the law today. We have buyers from the UK, from Germany, from Denmark that we sell to and we represent. They would be perfectly good owners of farmland in Indiana because they're gonna rent it to Indiana tenants and the inputs will be bought here and the outputs will be sold here. But they can't buy here today. They can buy in Ohio, you can buy in Michigan, you can buy in Illinois, those are all open states. You get to the Dakotas, Minnesota, Wisconsin, Iowa, and Kansas, Missouri, those are more restricted as well. And there's some talk federally that there might be some restrictions in the future, specifically to Russia and Chinese interests. So that'd be something to watch. Our buyers tend to be 55% last year farmers and 45% farmland investors. Now, I asked our staff, I just put this information in this morning. Yes, sir.
Is that last chart, just Indiana or is that across the nation?
That would be our sales, which would be Indiana, Michigan, Ohio, and Illinois.
Okay.
So just here in the eastern corner. Good question. So you can kind of see historically the farmer is the majority buyer. So I asked our staff, in your area, all sales included, who's the majority buyer? And you can see 84% farming and 16% farmland investor. That's a more consistent number across the Midwest. So before you think, because that's always the concern, well, the Chinese are coming in and buying a bunch of our land. They're not. I have yet to do a transaction with anybody affiliated with China or Russia in all the years, 34 years of doing this. So the majority buyer remains that farmer down the road. Why? Because it's the chance of a lifetime to own that farm I've driven by forever. And we did this in Wabash. We bought the farm next to us because it's your chance of a lifetime to do it. You will accept a lower rate of return on that farm because of its proximity than what the farmland investor will. Most farmland investors, institutional investors, series partners, and those types of groups are looking for a 3.5%, 4.5% kind of cash yield. That's not the market today. I've got a slide on that a little bit later.
Oh, okay, no, you go ahead.
So here's the Purdue Ag Barometer.
Really good.
This is something you can watch. The CME Group and Purdue put this out. They do this monthly. They survey 400 producers around the United States, and they ask them how they feel about agriculture. Clearly, it's 0 to a 200-point scale. So 130, that was the most recent one for February. That means we're above average. What I find interesting in this is you would think with the all-time high of farmland values over the last few months that it'd be euphoria, wouldn't it? Yet we're down in here. And when Jim Minter makes this presentation, he did this Tuesday at a seminar we did, he will point out that it's really fear of the future. Fear of where interest rates are going to go, fear of what trade and those kind of issues that we're going to have going forward. And so the unknown is a factor in why this isn't as high as what farmland values would suggest. Inflation is a factor. I said earlier, it's a 1-to-1 correlation. Think 1970s. So we had big inflation in the 1970s and farmland values went up accordingly. If you remember back to our USDA chart that said values were 4,400, we're even above what they suggested land values would be in high inflationary economies. We haven't had what I would call super high inflation, but through the US, it's been high inflation. And this is the chart just to prove to you. I didn't make that up. We are at the all-time high. This is the nominal value. Here's the inflation adjusted. And you can see just went above where we were in 2013. So if you want to know that you're selling at the all-time high, you're doing that. Farmland debt. We're going to talk about this real quick. Farm Credit will like this slide. If you wonder who you're borrowing from, who the farmers borrow from, half the loans out here are Farm Credit made. And then you've got commercial banks, a third, and then a whole host of others, FSA, insurance companies and like, make up the difference. So talk about debt. This is inflation adjusted, ladies and gentlemen. Otherwise, the bar graphs on the far right would be a lot higher. So we are above where we were in terms of total debt back in the 1980s. That would be concerning on face value, but look at the structure of the debt. And I think this slide shows it even better. Debt today, while we're above where we were then, is a much more concentrated in real estate. And what do real estate loans have in common, a little more common than what operating lines have? Long-term fixed interest rates that are lower, right? Farm Credit guys? Whereas your operating lines, your equipment lines are gonna be a little higher cost and more variable. So when we get into inflationary times in terms of interest rates moving up, it's less impactful in terms of overall interest cost. And add that one. Well, we'll do these and then we'll talk about it. There's total interest cost. Need to realign these slides. So this shows total debt in the blue and it shows your interest cost in the orange. So this is how interest rate manifests itself in terms of cost of production. And you can see we're not anywhere where we were back in 1980 because a lot more of the loans were operating in nature and they were more variable back then. And so when interest rates went to 15%, so a lot of costs went up. Now we'll go back. Percent of farm businesses and total farm debt by farm sale class. You can see that the debt, you've got small farms here, 100,000, doesn't take much in terms of income to be a farm today. But you can see the debt is really concentrated with those producers that over 1 million in sales. It's not hard to get 1 million in sales in production ag today. And so that's where your debt is really largely oriented, and that doesn't surprise probably anybody, because if you are a real farmer, which is more than 1 million in sales, and I'm not minimizing you, Pat, because you farm, but those guys that are in it full time, they've got debt because it's horribly capital intensive to get into the business. And then here's interest rates, and you can kind of see how low, almost ridiculously low they got due to the pandemic. And now where we've come back to where we're in that 7-8 range, 6, 7, 8 range, depending on the type of loan you're looking for. That's out of the Kansas City Fed. Interest expense is a percent of farm earnings. Pat sent me this slide. I think this is really handy. You think about it in terms of cost per bushel. And I said earlier, interest expense was super high back here in the 1980s. Well, this puts it in cost per bushel, 35 cents corn bushel. And gosh, in 1980s, you were talking maybe $3 corn. Well, 1980, but as we got into the later 80s, we're talking $1.50 corn. And 35 cents was going to interest. And today we're at 12 cents. So just a different way to look at it. Debt to equity, debt to asset ratios. So those solvency ratios, very healthy today at 15.24 or 13.22. And then you got this ratio of income into debt. So $1 million of debt, you can think about this on your own farm. You got $1 million of debt and your farm income is 250. That's a 4-to-1 ratio. Right now we're at 3-to-1 as an industry. So where's your farm in that? And you can kind of think about how that applies to you. What this chart suggests is when you go above 5.5, which is roughly right in here, 1976, 1977, then that's kind of a warning sign of where the market might go. We got above it in 2016. But because debt stayed steady and incomes went up, we kind of saw it kind of erode where now it's a pretty healthy 3-to-1 ratio. Loan repayments rates better than normal and delinquencies very low. I was with one of the larger ag lending credit unions, the CEO a week ago today. And I said, you got any loan problems? Like, 0. I think most ag lenders, you guys would probably say, as you look at your portfolio, really not many concerns out there today. So from a debt standpoint, farmland is in a pretty good spot. Real capital farm expenditures, they're up a little bit, but not near as high as they were back in 2011 and 12. So what I want you to walk away from is, yes, debt is at the all-time high level, but it structurally is in a pretty good spot. And as asset values go, where the ag industry is very healthy today. And there's a lot of liquidity that exists. So we can start to think about, could values go down? Yes, they could, but they're not going to crash like we saw in the 1980s. So as we think about land values going forward, it really depends on incomes, supply, interest rates, and supply of farms for sale. These are the same 3 factors, but they do change in their influence. Farm incomes have been very bullish the last couple of years. And as we think about 2023, there's a potential for them to be bullish again. Not probably as good a year as last year. Oh, by the way, last year was like an all-time record. 1973 was better. 1973 was better. And then you got to go back to World War II, 1940s. Interest rates, I would call them neutral to bearish today. And then supply, probably neutral. We generated a lot of cash in 07 to 13. We saw all that cash, not all, a lot of that cash drain away from 14 to 19. Thankfully, the government stepped in with market facilitation payment, followed by COVID payments. It kind of provided a bridge to where we got into better incomes in 21 and 22. Interest rates, we know are increasing. Farms for sale are more than 50%. So we'll talk about each of these. Here's farm incomes. And you can see over here, all-time high, well, not all-time high, but going back to 22, we had a very good year in farming in 2022. This is USDA farm income. Now, projections for next year, this year, I should say, not as good, but still better than these two bands that are the historical averages. So again, we got a potential to have this year be a pretty good year. Haven't planted anything yet, so we really don't know, but predictions are good. So this is the chart I was referencing. That's 1973. This is World War II. And this is 2022. So a pretty good income year last year. So when you think about what I'm going to talk about in terms of rents going up, it's probably not a surprise. Those, by the way, were inflation adjusted. Otherwise, it wouldn't be comparable. Another way to think about farm income. So right now they're projecting 150 billion. And we were, for gosh, 1973 through 2003, we were somewhere around 85 billion was kind of the average. Then we jumped to where I would suggest today we're at 110 billion. So when we're above 110, 115 billion, to me, that's favorable news. If we're below that, that's probably going to be a working capital drain. And then cash rents versus budgeted returns. So your economic returns to farmland are orange. Your cash rents are blue. What I will point out here is economic returns go up and rents follow more slowly. Economic returns have been going up. Rents are probably going to lag a little bit, but they could continue to go up at least for this year and maybe even next. So not making depends on what happens for this fall, but it certainly could continue to push rents higher because of those economic returns.
Hey, Howard,
Yes,
along that line, I was gonna ask the question. Historically, are there ever times when rents go down? And I see you do say you have a downward trend a little bit in the
yeah.
21, whatever, I can't see it.
15, 14, 15, 16.
Bear with me here. I got a chart on that. Well, this is our rent. There we go. So this is Purdue's survey of rents going back to 1992. Generally speaking, always up to 92. The market was kind of flat. You can see we certainly did see rents decline in 2014-15. So yes, rents can go down.
Can you put a percentage on that decline for me? I can't see one up in there.
Yeah, so the high was about 290, 300, and we declined to 250-ish. So
15% maybe.
10, 15%, and the land market went down 15%.
I know. I'm just
So-
worried about my income. that's all.
I understand.
If he'd have a better farm manager, he might not be somewhere,
You know, you got Neil, you got Joe. We have options. But yes, so rents can go down. But they tend to be fairly sticky. Again, they trail, when farm incomes go up, they do tend to trail a little bit. I'm gonna go back real quick. All these exciting points I gotta make.
That's a good question.
So I talked about just a second ago that the government program support was pretty critical to that time period of 18, 19, and 20. To the point being, this is inflation adjusted. Payments, U.S. government payments were all-time high, including back to the PIC certificates and Freedom to Farm days. So that was market facilitation payments for the phase one trade, or before the phase one trade agreement, combined with some PPP. Here's what would have happened to working capital had we not had those program payments in place. Would have been even more of a drag, and we would have been looking at land values being down more in 2020 than instead of being flat before we got into the better income in 21. Now, there's been this talk of renewable diesel. And you've heard about the whole United States air fleet moving to this. In fact, United Airlines put together $100 million fund to develop more of these renewable diesel plants out in Iowa. So soybean oil price is reflective of the demand for the renewable diesel. And you see that, in this chart. Soybeans to me were always about the meal. You think about the Bunge plant down in Decatur, it makes meal, right? Well, today that might change going forward, where oil isn't just a byproduct, it actually becomes one of the drivers of demand for soybeans. So that's on the positive side. If you want to be bearish, look at Chinese population decline. There are 1.4 billion people, and they say that because of their one-child policy for decades, they could be down to what, 700,000 people in the next 30, 40, 50 years? That would be a demand decline. So that's a long time. I don't even have that chart up here, but that is a report. Yeah. Impact to trade, because I was just talking about China. This is the phase 1 trade agreement. And we went from 29 billion in sales to 36 billion in that 1 year. And it was mostly corn and beef. Soybeans hardly even registered. But before you think our trade is going away with China, it hasn't. Look, this is 22. Even better this year. Trade deals do work. And they do stimulate, even though you hear a lot of news about Brazil selling beans to China. Timber values are up. Not a surprise. We have a lot of hardwood timber in Northeast Indiana. And you've got those values going up because of the housing market. Talked about this earlier. I mentioned institutional investors might want a 3.5%, 4.5% return. The market's not there today. The market is 2.25%, 2.5%. That's cash return on your investment. I asked Tuesday, Nolan, since you're a willing participant, what did the bank say they were paying for CD rates?
Recently,
Tuesday, they said they
Yeah.
quoted a number.
was it 3.5, 4?
4.5, yeah, or 4. So when CD rates are at 4 and the rate of return on farmland is at 2.25, there are some investors that might make a decision not to buy the farm and maybe invest in CDs. So it's alternative options. And I'm not saying that's really why a lot of people make a decision between farmland or fixed income instruments, but they could. And that's been a different equation for a number of years. So here's the survey. I just finished this morning. So this is very new data. I asked our group, results of 23 cash rents, 15 of our people said they had higher rents for 2023. Anywhere from $7 to $75 an acre. $7. That was an interesting number. Did you increase cash rents? Yes, 15 did, anywhere from 10 to 45. These were results of bid situations. Those were just our own increases. But you saw there, one guy commented, a couple that were a little bit below the market. Most of ours are flex. We do a lot of cash flex leasing. So you got a base rent and then the potential for a bonus. Demand. So demand is rated as the same. So this is, the number of farms that are out there for rent is the same. That's about 0. And this is the number of people wanting to lease farms, and that's up. Not a surprise, you had good income last year, so you're probably going to see increasing demand for farms to rent. Now, I mentioned cash flex leasing. It's a guaranteed rent. So let's say that's $250 an acre, half in the spring, half in the fall. And then you get a flex payment as a landowner if it's a good year, revenue-wise. And I just put these numbers in. So for 23, corn base gross revenues, the farmer gets this number here. Let's say it's $1,000 an acre. The farmer's going to pay the $250 guarantee out of that. They're going to pay variable costs, seed, fertilizer, chemicals, and their equipment and labor. And then if there's profit above that $1,000 in my example, they share some of that with the landowner. So let's say the corn averages 200 bushel and the average price is 6. That's $1,200 an acre in revenue. If our base gross revenue is 1,000, that's another $200 in profit. And if the landowner gets a third of that, 2/3 still going to the farmer. Landowner gets a third, that's another $66 on top of the $250 base. So all in, it's a $316 lease for this year. That's how the cash flex lease works. If we see an average price of $5 and the corn yield is 190, that's below the $1,000 gross and no bonus is paid, just the 250. And you can see that the base cash rent tends to be about 85% of what the fixed rent would be in that market. So the farmer has less risk on the front end and they pay a bonus only if one is warranted. That's why we do a lot of cash flex leasing. Tell you bonuses were really good last year because farm incomes were an all-time record. Here's the cash rent chart we just talked about. I would expect farmland values to go up less than what rents will in 23 when the survey is done in June. So we'll wrap this up with a forecast. We are bullish land values, not near what we've experienced, probably 0 to 5% up in 23. You looked at the chart that Pat had done earlier, it was kind of flat. But you've got global demand. It's just in time demand. And you say, well, Howard, what do you mean by that? I mean, the market moves if there's a hiccup anywhere in the world. If Russia and Ukraine decide to shut down their export deal for one day, what does it do? Corn and wheat moves up. If we get an announcement of Argentine drought, which we've been having, market moves up. If we get an announcement of rain in Argentina, the market will move down. So that's the just in time. Interest rates, obviously 6.8%. This was the Chicago Federal Reserve Bank District average for 15-year fixed money on farm loans. Real estate. I don't want to depict that as anything else, but that's up almost 3% from the bottom. Supply of farms picked up last fall. It remains kind of near normal. I wouldn't plan on much government support. As you talk to your U.S. representatives or the senators, I would be suggesting to Mr. Braun, and then we heard him present at Huntington University last fall. He said that expect the farm bill to look a lot like it does today. So I'm really supportive. Keep providing crop insurance, what, half of the premium, basically, plus or minus. So the government subsidizes what the imputed premium, half of it should be. That's a huge positive for agriculture. So we want to support that. And then they'll probably have an ARC-like thing or a PLC. Those are acronyms, I know, but those are the annual programs, and they'll probably keep those in place in some fashion going forward. I would not look for the farm bill to be dramatically different, maybe a few more conservation options out there. And then you got inflation. Input costs are actually coming down. Fertilizer has been dropping for the last 3 or 4 months. And then record incomes generated a lot of cash from last year. So I would say cropland values are certainly in an uptrend, not as fast as what they were. These other areas, a little steady to weaker. They're more reflective of the general economy. The general economy seems to be a little wishy-washy and knowing where it's going to go right now with the stock market. So if this could be a little more weaker to steady. I don't see it crashing and burning by any means, but when you think about the housing market starting to weaken a little bit, this would be an example. Be careful of these hassle farms, 80 acres and 5 fields. You want to farm 80 acres and 5 fields?
That's all we got.
Well, then you work with it, right? Yes, sir.
Hey, Howard, you said input costs are going down, and from what I've read, it does sound like fertilizer. Yet producer and input costs are going up.
Now, Purdue they did theirs last fall.
Okay.
Timing is pretty critical in that. And honestly, how many of you guys prepaid your fertilizer before you're in?
So they pay the higher cost.
So they paid a higher price. The reason they prepaid it was because they made a lot of money from last year, so they wanted the expense on last year's tax statement. That there you're gambling, right? Because you don't know if fertilizer prices were really going to go down much or how much they were going to go down this year, and you wanted to take the tax deduction. So
Purdue did revise their numbers in January and they came down slightly, but I think a lot of the fertilizer drop has actually happened in the last 4 to 6 weeks.
Yes.
Really. So you're seeing a little bit of a shift there now. Who knows how long that
but
lasts?
seed, equipment, and fuel, those haven't changed much. Those are other parts of that.
Those are all up from last year.
But in the long run, shouldn't input costs kind of go down? I mean, I don't mean the next month or 2 months or even next year, but I mean, energy costs are probably not likely to go up. Hopefully fertilizer is going to continue to go down a little bit over time.
Well, it's probably no surprise, but fertilizer really tracks corn price. So, yes. Because if the corn price is higher, you'll put on more fertilizer to make more corn. Follow me? And so as a result, when the corn price comes down, where are you gonna cut your budget quickly? Probably not on seed, and you can't change your equipment or labor. So what you can, and you can't really do much with about your fuel price, but you can cut your fertilizer. So that really, that's the one that can move the most. The others, we don't have a lot of control over. So I'm bullish. I think you got a lot of liquidity out here. Interest rates, while higher, are not super high historically. And financially, we're in a pretty good spot in agriculture. Biofuels, all your ethanol plants probably stay in production as they were, because the RFS for the next couple of years remains the same. And you've got all these other reasons why I think land values are pretty steady. If you want to be bearish, you want to make a bearish case, yes, you got higher interest rates. Let's say Brazil produces this whopping big crop, and then we layer on top of that a US record production. And globally, production is stimulated. Ukraine gets to produce a lot of what they can. You could conspire, and with worldwide recession, demand might drop, and therefore lower commodity prices come fall. $4.50 corn, $5 corn. $5 corn, believe it or not, while historically is very high, is below cost of production today. So something to watch. If we stay at $6, yeah, then it's profit. And you've got to watch the other asset classes, but we're steady to up 5%. And then this is when I asked my staff, these guys are really confident where the market is going. 4 said higher, 3 said lower, and 16 said the same. So that's that 0 to 5%, really. Residential lots lower and recreational land lower was the theme there. And again, this is as of March 1st. Yes, sir.
Howard, let's say 7 or 8 years from now, ethanol production, right now, electric vehicles are moving more in the spotlight, and 7 or 8 years from now, maybe 50% or 60% of the vehicles manufactured will be electric vehicles. So you look at the demand for ethanol and how much corn goes into ethanol.
Yep.
I'm thinking longer term as an investor, but how does that change the dynamics of farmland values and rents?
Great question. Very difficult to answer for these reasons. In theory, yes, fuel demand drops. EV, we've got to have more electricity. Where do we get it from? Coal-fired plants? Doubt it. Do we get it from nuclear plants? Maybe. Do we get it from solar and wind? Solar, which takes thousands of acres out of row crop production. So that could have a material impact on the number of acres that we actually plant. So that's one offset. I think the renewable diesel on the soybean side is a positive influence. My point is there are so many different factors that I can't bet that. Now you watch, total gasoline consumption is not going up with the end of the pandemic. Why? Because of electric vehicles. So they're having a material impact. You're exactly right. My concern with electric vehicles is how do we power the fleet? Where do we get the electricity from? Because we're not going to use less in buildings like this and at home. So that doesn't change. So where do we get the additional electricity from? And do we switch over to hydrogen energy? We had one of Joe's teammates, actually his brother's teammate, his dad works at Cummins. And he said their focus is hydrogen. Those are the big motors. So, Nolan, you have a question?
Yes, online. Do you expect cash rents on top quality farm ground to increase this year more or less than in 22?
More. Yeah, I would say that is going to be more. We've seen some rents. One thing Haldeman will not do is we're not going to do cash rent auctions. I don't know if anybody have read the guy from Illinois, Rothermanic or something like that, but he's been writing about these cash rent auctions. We don't do that. as farm managers, we will do sealed bids. But we're not gonna do a public auction of cash rents. That puts a real target on the farmer's back. Because, oh, by the way, other landowners can see how that, that's a bad, yes, sir.
You can come in on, fields that have been cover crop, the investors, which look at that more favorable, they're gonna invest in that ground and it's a good value of the ground for all parts.
Pat, do we have any data on no-till cover crop fields versus conventional?
I can't say we sold an organics farm down in Howard County here 2 or 3 summers ago. And it didn't bring any premium. In fact, all but one little tract of it went back to commercial production, so.
That's organic.
Yeah, it would be similar. I mean, but I haven't seen anything where cover crops have added any value to this.
I don't think there's enough cover crop farms that have sold to really get a grasp on that either.
Yeah, I don't suspicion they've added value. I do believe that reduced tillage and cover crops will add organic matter over time. But that's a long time. It isn't a 1-year type of thing.
Howard, we have more farm management clients asking for more ESG compliant rotation and crop, cover crops, tillage tools, that kind of thing.
And you have a lot of your end users that are under pressure to produce crops more sustainably. Frito-Lay, Weaver Popcorn, Red Gold. So there's a little more consumer demand that way. I think that could drive it going forward. We have a fund that we represent with one of our entities that they want to buy land that is operated sustainably. Now, that's always definition. There's no one common definition of that yet. Yes,
Is the cap rate that you had up there, does that include like some of those flex payments, that bonus?
that is not, Gary.
Okay,
That cap rate that I showed you in that chart is straight from the Purdue numbers.
I got you.
So that's taking the Purdue cash rent divided by the Purdue land. So that's a gross.
And then, over time, what's your sense of like, say, the trend of that base rent on those flex rents? Is it similar trend or is it
Yes.
a little bit flatter or
The-
volatile?
That base cash rent follows the same trend as the overall market, but it's less volatile.
Okay.
So you might have fixed rent, and I don't want to throw this number out loosely, but there are some rents you can read about in Illinois and places that are $500 an acre for this year. That seems crazy to me. Our base rent, while increasing in 23, isn't going to be ridiculous like that. It might get to 300 and there may be a bonus on top of that. But it's not going to be as high as that fixed rent and less volatile. To your point. Yes, sir.
Have you guys done any studies or do you have any thoughts on carbon credits and how that will transition with land at some point, as well as with tax rent in the future?
Yeah, that's a good question. Carbon credits right now, I don't see that many people signing up for them because they're not, $5 to $10 an acre. And I would not sign a contract to produce that way for $5 or $10 an acre. Maybe for 50, but not for 5 or 10. And that's below the cost of implementing the practices, right? So we haven't seen a lot of people doing that. My position, we don't have a corporate position necessarily on this, but I think as we think about carbon credits and who should get the payment, I think a lot of that should go to the tenant. Landowner's going to get the benefit of those practices and the increased organic matter and soil erosion reduction. The farmers doing all those practices, doing all the work and paying for the cost. I think the farmer probably ought to get a majority of that payment just to make up for what they're taking on in terms of their risk and the additional cost. All right, this is really good timing. As they're bringing out the entrees, I'm going to transition over to the Nicole and Brandon show with Farm Credit. I will switch over their slides and I'll let you guys just take it away. So Nicole, let me make the switch. I'm going to place it right there.
I'd say half of the.
He'd be able
It's.
I know back.
Where you can basically. And then what you have. Well, yeah, it's easy. Price. So, you know, sorry, one time I do that. That's a problem. Might be 10. What happened? I've liked, here. Thanks, sir. That's where you have you're not gonna. I know it, I know it, I know it. Well, it's on 100. I never was. Yeah, back. Years ago. I appreciate that. I like a lot of it. All right. Well, you see some of them. So it's, yeah, that does have
about two farm credits, few association update, and then we'll hand it over to our crop insurance team to give a crop insurance update as well. So farm credit Credit is nationwide, but our specific association that we are representing is Farm Credit Mid-America. We cover Ohio, Indiana, Kentucky, and Tennessee. As they said earlier, we're from the Bluffton office, which is kind of the local office to this area. There's one right over in Columbia City as well. Our headquarters is Louisville, Kentucky, so we have a corporate office down there with team members that help support what we do for you folks out here in the field.
Like Nicole said, within those 4 states, we have 135,000 customers. And of those, 285 are advocates. An advocate could be anyone out in the field, typically have 2 to 4 per office, so they're eyes and ears out in the ground. So what's going well at Farm Credit, is there anything we improve, what are competitors offering, is there any tools they can use in the toolbox to make them successful? And then as far as the board, we have a big board down in Louisville, and there are 14 members on that board, and they are elected by our customers. So there's a ballot that goes out every year, and the member customer has to vote for who they want to be on the board.
Thank you much.
All right, here in Northeast Indiana, when you think about Farm Credit, you probably mostly think about the row crop grain operations, and then depending on your county, it's like combined livestock operations. But we really, across our 4 states, cover a lot of other commodities and enterprises. Percentages of what commodities we work with are kind of up there. The other thing that I wanted to touch on as well, some opportunity that we do have is non-ag lending as well. So if you're a part-time or a full-time farmer, we do have the ability to work with your non-ag business financing needs. Some examples of that would be, I know we've got a couple of dog kennels that we've done. We also have some grocery stores, bakery, things like that. So we're not just all inclusive to farms. You do have to be eligible for those kind of opportunities by owning agricultural assets or having farm income, but we do have some other non-ag loans that we're able to do that diversify our portfolio as well. And then we also have a rural home division. If you guys are familiar with the brand Rural First, they do our consumer products, so home loans, home equity loans, and some recreational ground as well.
So this is a 5-year history here of where Farm Credit's been and what we've done financially. So about 5 years ago, we were a $23 billion association, again, that's Indiana, Ohio, Kentucky, and Tennessee. And now today with our year numbers at 22, to 33.5 billion. So about a 10 billion growth there. As far as net income, 430 million, that is still 21's number. We don't have 22 yet, but it should be very similar. That was a record too for net income, which that net income is really important because that keeps Farm Credit strong, and then it also allows us to pay the tax rate back to customers, which we'll talk about.
Yeah. So like Brandon mentioned, we do pay patronage. Some people call it patronage too, however you want to pronounce it. I don't care. We're excited about it either way. So this year with the patronage payments that'll be coming out in a couple of weeks, we will cross over the $1 billion mark that has been returned back to our customers since we started paying back in 2016. So we're going to pay back about 230 million this year. And that comes out the 3rd week of March for the prior year's business. It is a returning of Farm Credit's earnings back to our members. As we disclosed earlier, Farm Credit is a cooperative, so all of our people, or all of our customers that have loans with us, own stock with us, they are member owners.
So Nicole, what does that translate into interest rate reduction in a given year?
So it's going to depend on the product. The product does vary. So the highest patronage payment is on operating. And then on real estate, that's kind of the lowest paying product, and then the term loans are somewhere in the middle. So depending on the product and type of loan, you're looking anywhere from 0.5% to 1 3/4, maybe even as high as 2%. Again, with operating being at the high end of that.
But
Yeah, here we go.
here it breaks out by product. So here, ag mortgage, operating is over here, and it breaks it out by year too. But operating, I think, both typically pays the best. Our spread's the best from operating money, so that way we can turn the most money back on the operating line compared to the ag mortgage. This is Bluffton, a snapshot of just the Bluffton territory, which Bluffton is Adams, well, Allen and Jay County, that are different in the Bluffton office. In the Bluffton office, Nicole and I have about $2 million in checks going out here just for a few weeks. And of that, the average for the Bluffton territory is a 1.41% interest rate return. So for example, your average build rate was 5%, you'd be down that 3.6% net or so on average. But again, if you have more operating debt, it'd be a bigger percentage. If you have more real estate, it might be a little smaller than that. But it depends on what your portfolio is with our credit. You can see down here too, we continue to grow each year too, and pay out in our local office also.
The grant is the patronage,
Yeah.
different by office then, but you
So the percentages are real similar, but yeah, if an office has a bigger portfolio than another, it might have a bigger payout than a different office. But as far as the percentage though, it's very, very similar.
The calculation for patronage is loan specific, so if there were discounts already built into the loan, like, since it was discounted, that patronage payment would be lower on the back end, just because that discount's already built in and our spread on it is lower.
One other thing I'll note too, which Nicole will get into it more later, but if you guys, you have interest rates locked in 2-3 years ago, say at 3-4%, and you're getting 1.4, 1.3 patronage, sometimes the net cost of money is 2-3%. So you can imagine there's not a lot of pay downs right now on those fixed rates because there's a lot of alternative investments. We have something in farm credit Nicole will talk about, and you guys into CDs too. So we're not seeing a lot of pay downs on those fixed rates because the bigger the patronage in. Back when we started patronage 7 years ago, we weren't figuring on having this bonus on top of that. But if you already got a low rate and getting patronages, we have some guys down 2% over fixed on farm ground. But you had to do it a couple of years ago when we were low. Yeah.
Okay, we do have a program called the Grind Forward Program. It is a program that got started probably about the time patronage did, like that 2015 timeframe. To help support our young beginning farmers, obviously the aging population of farmers, we knew that there was a next generation up and coming that needed some support. So one of the big perks of this program, if the applicant is willing to fill out a business plan and attend a farm credit training, then they do get relaxed underwriting standards. So oftentimes those young beginning farmers, they don't have the net worth, they don't have as much cash in the bank, things like that. So it does give us the opportunity to still work with those folks, even though they are a higher risk customer. So we're able to approve loans that maybe 10, 15, 20 years ago, we weren't able to, just to support that next generation. I'll also add, it's not up here on the slide, but Farm Credit is a preferred lender with the Farm Service Agency. The Farm Service Agency does still have some really good programs for young beginning farmers. So if you have a next generation or grandkids or somebody that's coming up and wanting to buy farm ground, the FSA program is a really good opportunity for them to use, because the FSA half of the loan still has a much better interest rate than what like your conventional loan rates would be with bank or farm credit. So depending on the program, I think those rates are still between like 1.5 and 3.25.
Community involvement for Mid-America, this is over the last 5 years in the 4 states, but we've given out over 450 scholarships. I was looking at last year's over $200,000 scholarships that what Mid-America did. We're involved with 4-H, FFA, food banks. I know Nicole and I in the office, we went to Grable this last year and helped pack meals, and we cleaned tomatoes behind harvesters before and donated to the food bank. So we try and get boots on the ground and be in our local community.
For the scholarship applications as well, if any of you are farm credit customers, it's not only kids, but also grandchildren that can apply too. So
We typically have 2 per region. So Gary's region, we have 5 offices. One scholarship is $2,500, the other is $1,500. I usually sit on the committee for that each year. We do about 20 to 25 applications. Usually really good.
okay, we did talk around the sheet about the farm cash management accounts that we have. I know, again, Howard mentioned CDs, but this is an option for our customers that is completely liquid. So you don't have to have it locked in for a certain amount of time or a certain set segment. And currently that rate is at 3.2%. So pretty good return for money that you have access to every day. Like I said, it doesn't have to be locked in and kept in there for any certain amount of time. So if you have some, cash sitting in the bank that's not doing much, I know a lot of savings accounts haven't really caught up with the interest rate markets yet. It is a good opportunity to get that money invested in those farm cash management.
You have to be a farm credit customer currently to do that.
You do, yeah. So you have to be a farm credit customer or like a note signer on a farm credit note. Yeah, so, and there are opportunities, like if you aren't a current farm credit customer, a lot of times what we do is kind of a workaround is if you own ag assets or have farm income, a small line of credit that, you know, it's a way for you to become a customer without having the interest expense of like a term note, something like that.
Okay, this here is the 10-year treasury yield, so just a little bit, if interest rate outlook or where we've been. So the 10-year treasury is something Nicole and I watch probably about daily. Some days it's really flat, and then some days we get lots of volatility. So it's like the grain markets, corn and beans. Some days there's nothing that happens, and some days you might get 130 cents, like what happened that day? So our price sheet varies based off what the treasuries are doing. That's why we watch it so much. This is farm credit and other sources of what their cost of money is going back out. You can see this goes back to about 2018, and then we come up here when COVID happened and the treasury went down almost 0.5%. This is the 10-year. The short-term treasury is almost zero. We didn't go negative. Germany actually went negative for a while. We did not do that, but we got close to it. And then we started having inflation and started going up. So we're at 4.05 now. So like Howard said, we're about 3.5% higher than where we were just a year and a half ago on long-term money. And that follows pretty closely to what the treasuries have done here over the last few years.
All right, and then we also have a 30-year history of, or maybe it's 40-year history of prime. So as Howard mentioned, even though rates are up, they're still low historically. I hate saying that, but when you look at this section back at the back in the 80s, we did peak out with prime around 22% back in the early 80s. So right now prime is at 7.75. Last year was the big year for prime though. We had 7 increases. We started 2022 with prime at 3.25 and we ended the year with it at 7.5. So well over double there in 2022. The other thing, I don't know, there is a note in the bottom left corner. One of the things I thought was interesting, after some of the peaks of prime, those gray bars, those shaded areas are recessions in the economy. So you can kind of see how after about every peak of prime, there was a recession. So I guess we will see what the future holds. We're heading up on another peak.
Well, Nicole, I know you wouldn't remember the 1980s, but Pat remembers that time period very well.
He just about passed out when you mentioned.
Flashbacks.
If you're in ag lending, you hear a lot about
I'm
it.
sure you do. If you look at the trajectory right now, though, if you went from, like Nicole said, 3.25 to 7.5, it's almost straight up. And that's still the trend we're on right now.
One thing I would also add too, Nicole, you mentioned about those gray spots in the recession. You go back, a lot of times, what you'll see is an inverted yield curve. And what we're talking about, whenever you hear the economists say an inverted yield curve, is the long-term rates are going below the short-term rates. So short-term rates are higher than your long-term rates. And we actually are seeing a little bit of an inverted yield curve today. And historically speaking, the wider that yield curve inversion is, the higher the probability of a recession in the general economy. And so a good way to figure it is take that 10-year treasury less that 3-month treasury. If you got a negative number, and that's the inverted yield. And so there's a lot of speculation. Are we going to have a recession in 2023? And, you know, the talking heads, you know, that everybody's probably got their opinion, but that's one of those things you could follow to see what's happening in the general economy.
And one of the problems we could have had too, there's different theories, of course, that we want to listen to, but we were at practically zero for so long, and they kept saying inflation was transitory. And then, okay, we realized it wasn't transitory, and then they had to play catch up. That's why we're seeing this huge spike now, because there is much inflation in the general economy.
So if you have a recession, will that make interest rates go up or down?
Usually when things are times are negative, interest rates come back down. They're trying to stimulate the economy by making borrowing costs cheaper.
Yep, and you can kind of see that too, like with where those gray bars line, where all the gray bars are, it's typically in a downward.
Yeah, right here is the home loan crisis. Oh, wait, 09, 10 home loan crisis. They brought it down basically. The Fed rate was basically zero. And we were there for 7, 8 years before it started to improve. Here's COVID. COVID happened right here. Back down to 0 and Fed rate, and we're going back up again.
Now, I don't know that we'll see it happen overnight like we did with COVID though. COVID, when that happened, it was just like.
Okay, the CME group, they do, it isn't public information, you can Google it, but they have a tool, you can look at what the probability is of what the Fed will do at their next meeting. So right now, we're right around that 4.75 we'll mention, so. with
Yeah,
the-
so the target of where we are right now is up here.
So the next meeting here is coming up on March 22nd. The Fed meets every 6 weeks and they can leave rates alone, they can increase them, they can lower them. But what this numbers are telling us is right now there's a 67% probability that the Fed will raise rates by 0.25% at the next meeting. Going down, 0% chance, even staying the same. Right now, they're saying there's 0% chance of staying the same. And there's even a 32% chance that it will go up by 50 basis points, or 0.5%. So if you're hoping rates are gonna go down, you might have to wait a little longer.
That was straight the messenger.
Yeah. And this just goes out further yet. This will be the following meeting after that, for the May 3rd meeting. Again, right now, the probability they're saying is around 63, 64% of another 0.25% at that meeting. A little lower on the 0.5%, about 34%, but there's even a 2% chance that it might be 3/4 on that following meeting. So again, even the next meeting, they're still projecting higher interest rates. And then the last one we have here is the June 14th meeting. The only good news, I guess you could say here, maybe if you don't like higher interest rates, is there is a 12% probability that rates will stay the same. They won't raise it. But still, the consensus is though, probably another 0.25% on that meeting also. So if you take the next 3 Fed meetings together until June 15th, we're probably looking at another 3/4 is what they're saying right now. Of course, that can change based off new information. So if prime 7.75 now, we're probably around 8.5% the middle of June comes around, which will affect everyone's operating line and short-term money borrowing costs. That's all I had. I'll turn over to the crop insurance team. There, you good? It's my turn. Your turn. Good.
Thank you, guys. Just that I'll put cheaper.
Okay, my name's Eric Johnson. I'm a crop insurance specialist at Farm Credit. So you guys heard the update on the loan side. I'm gonna try to give you a little overview of Farm Credit's crop insurance and risk management side of things. And I'm gonna try to keep that a little bit brief because I am the last one to present. Also in part, I heard they're gonna have peanut butter pie for dessert. And I know if I leave my pie sitting over here, somebody's gonna lie down and get it, and I don't want that to happen. So we're gonna get through this here. But again, I'm Eric Johnson, crop insurance specialist. I cover the Bluffton office, which is where Brandon and Nicole are from. I also cover the Marion office. So I've got about 7 or 8 counties here in Northeast, East Central Indiana that I cover on crop insurance specifically. A little bit about how Farm Credit's crop insurance team here in Indiana is made up. We have 12 dedicated agents to row crops, corn, soybeans, and wheat. Scattered across the state in our own little territories there. And then we also have one specific agent that is dedicated to livestock. Your independent livestock producers, your dairy, things like that. There's some different programs and different policies and different things on the livestock side. So we've got a guy dedicated just to the livestock, but then the 12 of us on the row crop side. And for about every 2 agents, we've got a support staff, kind of an administrative person behind the scenes, and I hate to say administrative because they do much more than just administrative work, but they keep us pointed in the right direction, keep us sales folks out on the road and doing the right things. I think the 1 million acre number might have been from last season where it took over 1 million acres insured in Indiana. So we get around, we cover kind of every corner of the state here and know what's going on here in Indiana. And then I also want to mention it's maybe a little bit of a competitive advantage, I feel like. is the fact that all of our crop insurance agents are not commissioned agents. We're paid a salary for farm credit to go do a job. And so I think that's a good thing because there's different policies, different programs, different things that you can do that compensate the salesperson, the agent from a commission standpoint. We don't have that influence to go to the farm and cookie cutter. Everybody's got to be this because, you know, we want to make our piece. We're going to go to the farm and we're going to put a plan together based on what's important for the farm. And go that route. So I think that gives us a little bit of an advantage there. One of the other things that I wanted to mention as far as the competitive advantage goes, this is a couple of snapshots from some decision and analysis tools and resources that we have in Farm Credit on the crop insurance side. The Farm Credit has really made an effort, put an emphasis on having some tools and resources for us to be able to make informed decisions, data-driven decisions on crop insurance. We try to take some of that emotion out of the equation and really make a decision and look at things based on, hey, what is the best option? What makes financial sense, risk management sense for each operation? And these tools are exclusive to Farm Credit. So the tools, some of the things that I'm looking at here and that we have to go to the farm with as far as growers, your Sylvia's group doesn't have this. Williamson doesn't have this. Some of these tools are exclusive to us and kind of gives us a leg up on, again, making data-driven and informed decisions on what's the best thing to do risk management wise for your farm respectively.
Sir, to that point, are a lot of people making a change based upon where the February pricing came out or not?
A little bit. There was some changes made more so last year as far as if we're gonna make a change on coverage level, we're gonna add this or take this away. So last year the prices went way up, right? I mean, revenues were at all-time highs, so the guarantees were all-time highs last year. So I think there were some significant changes made last year. There are some this year that are making changes. Maybe they didn't last year. So they're taking the opportunity, hey, we're still at pretty high prices. Let's look at it. It kind of goes both ways though, because in the last, we haven't had a really widespread claim here since 2015 in kind of northeast Indiana. And so guys have been dumping really good yields into their APH databases here the last 4, 5, 6 years. You know, Howard, one of your polls, and we've got guys, we see guys with approved yield history is well over 200 at this point. And so even with where the price is and it's really high APHs, your basic 80% policy has a really high revenue guarantee.
Yeah.
So, I mean, again, this is to the point where I was talking about the standpoint, from a data-driven standpoint. I've had a number of guys go from 85%, or they've been buying up some additional coverages. And they're gonna back down to an 80% policy right now because the revenue guarantee is at or better than their cost of production.
Sure.
And so we're not necessarily looking at it as an investment. Like, we're not trying to shoot the moon and get a claim every year. We just want to protect what we've got out here and let's move on.
Exactly.
And so I'm seeing some of that where you've got guys that want to take advantage of high prices. And you've got some guys that are trying to pull the reins back a little bit and say, hey, look, I'm covering an awful lot with a good solid 80% revenue protected policy. So the slide that I've got up here right now is with the updated spring price. I've got one for soybeans after that. So you can see last year we were at 590, we're at 591 this year, a penny. Okay, we're right where we were last year. But even though we're real close to last year, if you look back historically over the last 15 years, there's only been one opportunity to lock in higher revenue guarantees. So we've got an opportunity right now to lock in some of the highest overall gross revenue guaranteed crop insurance that we've ever seen at $5.91. What the spring price, for those that don't know, we take the average for the month of February for the new crop contract. So on corn, it'd be the December 2023 Chicago Board of Trade contract. Soybeans, the new crop contract is November. We take an average of that price for the month of February. That's how we set our crop insurance spring price. So on soybeans, it's pretty much an identical story. We set 13.76 is the spring price this year for soybeans. And again, from last year, yeah, we're down 50 or 60 cents. Okay, yeah, we're down a little bit, but last year was a record by a long shot. Last year was a tremendous revenue guarantee year. And so again, if you look back over the last 15 years, we're still at the second best opportunity to lock in a revenue guarantee at 13.76. It's just numbers that we typically historically don't see. So again, the opportunities are tremendous as far as locking in risk protection.
I should have shaded my.
Howard, you mentioned Farm Bill and Arc and PLC, I wanted to make a comment too, aside from just crop insurance, we really try to stay in tune with what's going on at FSA, USDA programs, things like that. To offer, guidance and support as far as making those decisions go. We got until March 15th to make that sign up for this year. If you guys have questions, we're gonna be around for a few minutes. I'm more than happy to help answer any questions after the fact, but it's something that we really try to be in front of our growers and customers as well, just to support them in any way we can. You mentioned the new farm bill. There's not a whole lot of information coming out from what I have heard. It sounds like the ARC and PLC programs are going to fairly stay intact with what they are. Hopefully, they're gonna bring up some support levels, because right now, those farm programs are at price levels that are not supportive in any way, shape, or form. And so hopefully there's some initiative there to bring those up to a more supportive level. And then, like you mentioned, some of the other farm programs, the ad hoc programs like MFP and
Conservation.
yeah, some of the conservation things, but then other just direct payments. It sounds like some of the direction, like WIP Plus was one of them, some of the disaster relief type payments. It sounds like there's gonna be a movement away from some of those, direct payment type programs and funneling some more of those funds into broadening offerings as far as revenue-based crop insurance, adding in some other maybe margin type product availabilities and some things like that, whereas they're funneling some of those resources more to, if guys want to pay for the coverage, here it is, we're gonna give you more options. We're not just going to have all of these hoops to jump through at FSA to get this payment, get that payment, and turn this in and that yield and some things like that. So we'll see, we'll know more here hopefully later this year, both sides of the aisle get along so good. So we're gonna hammer this out real quick and we're gonna know what's going on.
That's an official farm credit theory.
There's an asterisk, there's an asterisk. So I guess we'll see. That's the official.
You have way more insight than what I.
I wanted to mention a comment because price levels are where they are. I didn't really want to make the presentation a sales pitch in that sense of the word, but because of price levels and yield levels being where they are, I wanted to mention that, for those of you that have coverage levels at 75 to 80%, a product that I would really highly recommend you at least asking about investigating is SCO, supplemental coverage option. For the growers that are higher than that, they're already taking an 85% policy, or they're buying up some other bands of coverage. Might not make financial sense as far as risk management goes and protecting what you have out there, but that 80% policy that is a really typical, really common coverage level. An SCO band of coverage is a really economical way to increase your coverage level, gain a higher trigger level, and really it's subsidized at a really highly level, higher than most of our revenue protection policies. So again, for where it's triggering and what it offers, it's really cheap product. It is one of the best bang for the buck type products in crop insurance today. I wanted to mention supplemental coverage. If you have questions on that, want to learn more about it, happy to answer any more questions, but I wanted to throw that out there, given the price and yield levels that we're at. It's a really good buy right now in crop insurance. Really, for 2023, there were not a lot of changes in crop insurance over the last couple of years. There's been a significant amount of change, some new products coming out like the SCOs. ECO is another band of coverage product that's relatively new. And there's been a lot of change. Really, for this year, there wasn't a whole lot of change. And so one of the things that did change, and I wanted to mention that does have here around Fort Wayne, Allen County, and surrounding counties, is the RMA, the federal crop insurance side, did change plant dates, the early plant dates for soybeans. So in the past, the early plant date, that first date really from a crop insurance standpoint, to be out there in Allen County was April 24th. They've moved it up now almost 10 days, April 15th, trying to align with the movement that technology increases and seed and some of that kind of stuff. That's the movement right now, is we're moving to planting earlier. So they are at least following that trend and giving guys that opportunity to still have that coverage and move those dates up a little bit. Corn dates didn't change. Corn dates in Allen County are April 10th. That's the same. But soybeans, I wanted to make a comment that they had changed the soybean dates for this next year. Before I wrap my part up, I just wanted to throw out a couple of dates to remember here. We are in the spring. This is crop insurance season. March 15th is the deadline to make any changes, sign up a new policy, transfer a policy from one provider to another. The deadline is March 15th, so we got less than 2 weeks here to make those changes, but that date is coming up here quick. And then production reporting, so guys reporting their yields to their agents. Technically, the date is not until April 29th. Encourage you to, if you haven't done so already, work with your agent, get those yields in, because I'm guessing a lot of folks are gonna have other things on their mind on April 29th. Returning yields from last year. So wanted to make that comment there and remind of those dates. Again, I appreciate, my name is Eric Johnson, my counterpart Tanner Cribble is also here. He covers north of where I cover, so Allen County and north, kind of the northeast corner of Indiana here. Yeah, thanks Aldermans for having us here and letting us be involved, and again, we'll stick around here for a little bit and get any questions if you guys have any, so.
All right, any questions from anybody about any of the topics that we just covered today? Yes, sir.
In your last part there about crop insurance. How many people, percentage wise of the farmers, do that nowadays, would you say?
Is it 75–80%?
I would have to guess north of 80%.
Yeah.
It'd be my,
In Indiana, it's more than 90.
is it 90 in Indiana?